When you're trying to understand a massive consumer brand, sometimes the product you see on the shelves, that thing you just grab without thinking, is actually the least interesting part of the story.
That's a great way to put it.
Because the real complexity, the real risk, it's all hidden in the supply chain. What looks like a simple can of soup can hold a whole world of geopolitical risk and some really complex strategic choices.
It's a fantastic frame for what we're looking at today. We are taking a deep dive into the Campbell Soup Company, CPB. It's a classic American brand for sure, but its current strategic and financial reality is, well, it's far more dynamic and, frankly, a lot riskier than you might think.
Right. And our mission today is pretty simple. We want to give you the critical puts and takes, all the high-level knowledge you need to get up to speed on CPB's current position, especially if you're interested in the investment landscape.
And we're guided here by a really comprehensive research report from Compasscope, and we've also supplemented that with key insights from their most recent Q4 fiscal 2025 earnings call.
Exactly. This is your shortcut to understanding what's really moving the needle for Campbell. So let's start with the basics. Campbell is a CPG powerhouse built on these incredibly recognized brands. For decades, they were just soup. How is the business actually structured today, and what does that tell us about where they're headed?
Well, the current structure is really defined by two major operating segments. And the fact that they're basically equal in size is, I think, the core strategic takeaway right now.
Okay.
First, you have the legacy core, what they call the Meals and Beverages segment. It's the traditional Campbell business shelf-stable soup, Swanson broths, Pacific foods, juices like V8. But even this segment is going through a massive renovation.
How so?
It now houses brands like Prego sauces, and crucially, it includes their recently acquired premium line, Rouse Homemade and Michelangelo's. That acquisition, it just signals everything about their intent to move this segment away from pure legacy staples and more toward higher margin premium stuff.
And the second segment is where all the aggressive growth is supposed to come from, right?
Absolutely. The snacks segment, this now accounts for a full 50% of Campbell's total sales. I mean, that's a deliberate strategic shift.
50%.
And it's a powerhouse in its own right, very diverse. You've got savory giants like Goldfish, Pepperidge Farm crackers, Snyder's of Hanover, Kettle Brand chips. And then on the sweet side, you have Milano and Farmhouse cookies.
Wow. 50% snacks is a massive change. That instantly tells you that, okay, the soup business provides incredible stability. It's a cash cow, but the future of CPB is now heavily, heavily reliant on driving growth from crackers and cookies.
That's it. You're looking at a company that is actively prioritizing snacks as its high-growth engine. They're trying to move away from being overly reliant on that mature, albeit totally dominant soup business. That balance is what defines everything for them today.
Okay, let's pivot from structure to competition. What gives Campbell its defensive strength, its competitive moat, so to speak, and where are they most vulnerable against some of their bigger global rivals?
Campbell's moat is, it's deep, but it's geographically very constrained. Their strength is really two-layered. You have formidable brand equity and these efficient cost structures that are built on domestic manufacturing.
So they're big in the U.S.
Oh, they dominate. They absolutely dominate U.S. shelf-stable soup with a remarkable 60% market share.
60%, that's a fortress.
It is. It's a highly defensible position that just generates predictable cash flow. And because they lean so heavily on their domestic network, their direct operating margin sits around 26%, which is right in line with the industry median. It's a sign of efficiency.
So they are absolute masters of their specific domain here in the U.S. But if they're so concentrated stateside, what are the big risks they face that, say, a more globally diversified company might be able to avoid?
The vulnerabilities are specific and pretty acute. The first challenge is that while soup is stable, about 25% of their revenue is tied to this really slow-growing mature segment. So when the economy tightens up and people start looking for value, that segment is highly vulnerable to private label brands. If consumers start buying generic broth, Campbell's feels it immediately.
Okay, that makes sense.
The second, and this is maybe the most unique vulnerability, is their cost exposure to specific government policy. They are critically susceptible to the Section 232 steel and aluminum tariffs.
Okay, let's pause on that. For anyone listening, why are those tariffs so important to Campbell in particular?
Well, because Section 232 refers to tariffs on steel and aluminum imports based on, national security grounds. For a company that packs a quarter of its product in shelf-stable cans, This tariff basically acts as an immediate government-imposed tax on their single most crucial input,
So it's a direct hit.
a direct hit. This kind of cost volatility doesn't affect a rival that's focused on, say, plastic packaging or frozen meals with anywhere near the same severity. It is a highly specific structural headwind for them.
And when you compare them to their peers,
It becomes really clear. Mondelez, for example, has a much stronger global footprint, great exposure to emerging markets. Kellanova is also globally focused on snacking with brands like Pringles. Campbell's strength is deep and focused. They are the category specialist in the U.S., but they just lack those broader, more scalable international growth paths that their global counterparts use to hedge against, domestic economic cycles or a specific U.S. policy risk like this.
okay, so given those constraints, a mature core business, intense competition, and this unique tariff exposure, how exactly does Campbell plan to grow? What are the key pillars they're resting this whole strategy on?
They're relying on a very aggressive three-pronged strategy. First is what they call a portfolio shift and premiumization. The Sovos brand's acquisition, which brought in Rao's Homemade, is the most obvious sign of this. They are literally buying their way into the high-margin premium sauces territory.
So they're betting that people will pay significantly more for quality.
Exactly. They're just trying to sell more soup. They're trying to sell a smaller volume of much more expensive, higher-margin specialty goods. That acquisition is supposed to fuel growth for years.
And the second pillar.
The second, and it's a necessary one, is cost optimization. They are targeting a really aggressive $375 million in cost savings by fiscal 2028.
Wow.
And this isn't just, trimming the fat. This represents a 50% increase over the previous estimates. This massive organizational surgery is essential because those savings are required to fund the third pillar, innovation.
So they're taking that money and plowing it back into the business.
That's the plan. They're channeling that $375 million into marketing and consumer insight-driven products like avocado oil kettle chips or new flavored broths, making sure their products align with what people want today: health, flavor, convenience.
That $375 million target sounds incredibly aggressive. For context, how significant is that number? And I guess, is there a risk they sacrifice quality on a premium brand like Rao's just to hit those numbers, which would kind of undermine the whole strategy?
That is the absolute core conflict of the strategy. A target of $375 million is a huge chunk of their annual SG&A expenses. Achieving that requires serious integration success. The potential payoff is huge, though.
Right.
Successful execution could drive their adjusted operating margins over 18% by 2034. Rao's alone is expected to deliver mid to high single-digit growth. But yes, the risk of dilution is very real. If the need for cost savings means less marketing for Rao's, or worse, sourcing cheaper ingredients for a premium brand, the growth potential is severely capped.
And it all comes back to that U.S. focus.
It does. Because they lack that geographic diversification, their long-term growth ceiling is just lower than their global peers, which makes that domestic cost-cutting all the more critical.
Which brings us right to execution risk. I mean, integrating huge acquisitions and hitting these massive cost targets is tough in the best of times. What are the core risks we should be watching here?
The number one execution risk is integration. Simply put, capturing the synergies from the Sovos brand's acquisition is essential to hitting that $375 million target. If they fumble that integration, the margin improvements they don't materialize.
And they're left exposed.
Completely. The second huge risk is financial discipline. The Sovos deal, naturally, it elevated their debt. They've worked to bring their net debt to adjusted EBITDA ratio down to 3.6 at the end of fiscal 25, but that's still in the high end for a major CPG company.
So what does that 3.6x debt ratio actually tell us? Why should someone listening care about that specific number?
A debt-to-EBITDA ratio of 3.6x means it would take nearly 4 years of the company's operating profits just to pay off its debt.
Yeah.
Ideally, for a company like this, you want to see that closer to, 2, maybe 2.5. It exposes them directly to interest rate risk, and it really limits their firepower for future acquisitions or major reinvestment if the economy slows down.
And I imagine the tariffs are an execution risk, too.
It's a dual threat now.
Right.
It's not just the Section 232 steel tariffs hitting the soup cans, but now also tariffs on specialty Italian imports that affect Rao's premium ingredients. That cost volatility is a structural burden they have to execute perfectly against.
All right, let's get to the validation. What did the last quarter, Q4 of fiscal 2025, actually tell us about how this strategy is performing in the real world?
The Q4 results, which came out in September of 25, showed a mixed, but I'd say strategically encouraging picture. Earnings were a bit ahead of what people expected. Organic net sales did decline by 3%, but that was mostly just technical noise from the timing of shipments from Q3 reversing.
Okay, so what was the good news?
The good news was, in that meals and beverages segment, consumption continued to outpace the category. It was driven by that at-home cooking trend, which is a key value-seeking behavior we're seeing. Condensed soups, broth, Italian sauces all did well, and critically, Rouse dollar consumption returned to high single-digit growth.
So that's a big data point. It validates that their premiumization bet is actually working right now.
It does. It shows it's resonating.
And what about the crucial growth engine, the snacks segment? How did the 50% of the business perform?
Snacks was still the challenge. It showed a 2% consumption decline. But, and this is a big but, there was sequential improvement in share performance. 5 out of their 8 leadership brands saw their share improve from the prior quarter, which suggests the innovation is starting to gain some traction.
Is there a specific example of that innovation working?
Yeah, a great one is the premium Milano white chocolate lineup. It grew 27% year over year in consumption. It was the #1 driver of dollar growth in its category for the last 2 quarters. So that validates their pillar of using consumer insights for these premium flavor-forward products.
So sequential improvement, but still some lingering pressure. But the biggest takeaway, the one that really hit investors, was the guidance related to all those cost pressures we've been talking about.
It was the crucial point. Full-year adjusted EPS for fiscal 2026 is expected to decline significantly by 12 to 18%. And here is the defining insight from the call. Approximately 2/3 of that severe decline is attributed entirely to the estimated net tariff impact.
Wow, 2/3.
Just think about that. A political risk, not a market or consumer risk, is driving 2/3 of their expected profit drop. And that's despite the company trying to mitigate 60% of the gross tariff costs. The severity of what's left is just hitting the bottom line that hard.
And I saw they also made a move on ingredients.
They did. They're aligning with those broader consumer trends. They announced they're removing all FD&C color from their food and beverages in the second half of fiscal 2026, which is basically what you have to do now to meet that consumer demand for cleaner labels.
What a detailed balancing act. So to summarize all this, if you're monitoring Campbell Soup over the next year, what are the most critical factors you need to be watching?
You have to prioritize based on impact and uncertainty. #1, without a doubt, is tariff and input cost pressures. It is the single biggest uncertainty, and the FY26 guidance proved it. Their ability to mitigate those costs and surgically pass through pricing without, killing their volumes, that will define their profitability this year.
And beyond the tariffs, what about the strategic pillars themselves?
Second, you have to watch snacks, segment stabilization, and growth. Since it's half their revenue in their designated growth engine, you have to watch for that expected stabilization in the second half of fiscal 26. If it stabilizes, the strategy's on track. If not, they're in real trouble.
And the big acquisition.
That's #3. Rouse growth and premiumization success. If Rouse falls short of that mid to high single-digit growth, the entire premium margin bet is weakened. They just won't have the profitability they need to offset the slow-growing soup business. And finally, you have to monitor their progress on cost efficiency.
Right, that $375 million.
Exactly. The entire strategy of funding innovation and cushioning against tariffs is fundamentally underpinned by hitting that aggressive target by 2028. That goal has to be tracked really rigorously.
So Campbell is trying to maintain its dominance in a mature U.S. core while simultaneously forcing growth through premium snacks and aggressive cost-cutting, all under this unique, concentrated shadow of regulatory tariff headwinds. It's a really high-stakes domestic play.
It is. And it raises a really important question for you to consider. Given the absolute necessity of hitting that $375 million in cost savings to survive this tariff storm, should Campbell be willing to sacrifice some profitability to maintain the premium quality of a key brand like Rouse? Or will the unavoidable pressure to cut costs eventually lead to a dilution of that premium experience they are betting their future on? That's the trade-off they're facing over the next couple of years.
Knowledge is served. Thank you for joining us on the deep dive. Use this knowledge wisely as you look at the supply chain and the shelf. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.